Hello everyone. Welcome to our finance channel. In this video, we will talk about how to invest in the stock market for beginners. Investing in the stock market may seem intimidating at first, but with the right tips, anyone can start investing and grow their money. Step 1. Understand the basics. If you are a beginner in this field, it is important that you take the time to learn the basics before making any investments. The first thing you need to understand is the meaning of stocks. Shares represent an ownership stake in a company. When you buy a stock, you become a shareholder of that company, which gives you certain rights, such as the right to receive dividends and to vote on important company decisions. It is also important to know the difference between common stock and preferred stock. Common shares are the most common and entitle you to one vote in company decisions, while preferred shares usually have a fixed dividend and do not give you voting rights. Another important concept to understand is diversification. It is not advisable to invest all your money in one company, as this exposes you to greater risk. Instead, it is better to invest in several different companies and sectors to reduce risk and increase your chances of making a profit. In addition, you should be aware of factors that can influence stock prices. Economic events, news, and financial reports can significantly affect the value of a company. Therefore, it is important to be aware of relevant news and events and to keep track of the financial reports of the companies you are interested in investing in. Learning about stocks, diversification, and the factors that affect stock prices will help you make more informed decisions and reduce the risk of loss. Spend time learning these concepts before you make any investment, and you'll be on your way to a successful stock market investment. Step 2. Set investment objectives. Investment objectives help you focus on your financial goals and make informed decisions about how to invest your money. Here are some steps for setting effective investment objectives. First, it is important to assess your current financial situation and determine how much money you have available to invest. You should also consider your income and expenses, as this may affect your ability to invest on a regular basis. Next, it is important to set specific and realistic financial goals. How much money do you want to invest? How long do you want to invest that money? What kind of return do you expect to get on your investments? Once you have established your financial goals, it is important to consider your risk profile. Are you willing to take on more risk in search of higher returns? Or do you prefer a safer investment with a stable and predictable return? The answer to these questions will affect the investment strategy you choose. Another important step is to research and evaluate different investment options. Research the companies you are interested in investing in, and review financial reports and market news to make informed decisions about your investments. Once you have established your investment goals, it is important to track your progress. Regularly review your investments and evaluate their performance in relation to your financial goals. If necessary, adjust your investment strategy to keep your goals on track. Step 3. Do research and analysis. Before making any investment decisions, it is important to conduct thorough research and analyze relevant data to make informed decisions. Research involves seeking information about the company you are interested in investing in. It is important to learn about the company's history, its current financial situation, its organizational structure, and factors that may affect its future performance. In addition, it is important to pay attention to news and financial reports related to the company you are interested in investing in. Economic news, earnings reports, and other factors can have a significant impact on the stock price and the profitability of your investment. Analysis involves using the information gathered during research to make informed decisions. You can use different methods of analysis to evaluate a company, such as technical analysis and fundamental analysis. Technical analysis involves analyzing the price and volume patterns of the company's stock to identify trends and patterns of behavior. Fundamental analysis involves evaluating financial data and industry and economic factors to determine the company's fundamental value and future growth potential. It is important to keep in mind that research and analysis do not guarantee success in investing in the stock market. There is always risk associated with investing in stocks, and stock prices can fluctuate unpredictably. However, research and analysis can help you make informed decisions and reduce the risk of stock market losses. By devoting time and effort to research and analysis, you can improve your chances of success in stock market investing. Step 4. Diversify your portfolio. Diversification involves investing in different types of assets and companies, which helps reduce the risk of loss in case one investment doesn't perform as expected. Instead of investing all your money in one company, diversification involves investing in several companies in different industries and sectors. By doing so, you are reducing the risk of loss in case a specific company or sector experiences difficulties. Diversification also involves investing in different types of assets, such as stocks, bonds, real estate, and mutual funds. Each type of asset has its own level of risk and return, and diversification allows you to balance portfolio risk and return. In addition, diversification can also help take advantage of investment opportunities in different markets and sectors. While some markets may be in a downturn, others may be in a growth phase, which means that diversification can help you take advantage of growth opportunities in different sectors and markets. However, it is important to keep in mind that diversification does not guarantee success in stock market investing. There are still risks associated with investing in stocks, and stock prices can fluctuate unpredictably. It is important to establish an appropriate balance between diversification and concentration. Concentration involves investing in a limited number of companies and sectors, which can increase the risk of loss, but can also increase the potential for gain. Step 5. Maintain a long-term mindset. Maintaining a long-term mindset is essential when investing in the stock market. Often, investors are tempted to make short-term decisions based on recent news or changes in stock prices. However, this short-term mentality can be detrimental to a successful investment strategy. Investing in the stock market is a long-term activity. Investors should keep in mind that stock prices can fluctuate in the short term due to a variety of reasons, such as changes in the economy, corporate news, or even global events. However, the real opportunity to profit through stock investing is over the long term. When investors adopt a long-term mindset, they are more willing to make sound investments in companies with solid fundamentals. Rather than looking for the quick profit, investors with a long-term mindset look for companies with a history of growth and a solid long-term strategy. In addition, maintaining a long-term mindset can also help investors stay focused on their long-term goals. When investors have a long-term investment horizon, they can make more informed investment decisions that are aligned with their long-term goals. It is also important to keep in mind that stock investing is a long-term activity that requires patience and perseverance. Investors must be able to resist the temptation to sell their stocks in times of market volatility or stock price swings. Long-term minded investors are more likely to make sound investments in companies with solid fundamentals. Stay focused on their long-term goals and resist the temptation to make investment decisions based on short-term events. Stock market investing is a long-term activity that requires patience and perseverance, and investors with a long-term mindset are better equipped to succeed over the long term. There you have it. Tips for beginners on how to invest in the stock market. Remember, investing in the stock market is not an exact science, but with the right research and a long-term mindset, anyone can make their money grow. If you like this video, be sure to like it and subscribe to our channel for more finance content. See you in the next video.